Joining me live for more on this, Chris Weston, Head of Research at brokerage firm Pepperstone. Look, the only thing people really want to know is, does this mean no more rate rises? What are your thoughts?
At the moment it does, yeah. I mean, I think if you look at market expectations for the September meeting, there's absolutely nothing being priced, no expectations at all. We can go at expectation.
Which wasn't always the case, was it? I mean, go back a month or two and there was definitely another rise coming.
We've priced out a bit of the premium that was coming in there, but for the last couple of weeks there's been very low expectations. And after today's jobs number, which you have to say could only be seen as soft in the Reserve Bank's eyes, full-time jobs being lost, the unemployment rate rose despite participation rate falling. That's a soft number, and therefore there's very little chance we're going to get a rate hike in September, especially with concerns brewing around what's happening in China at the moment and foreign afield. There is, if you go to the next chance, probably November could be an interesting one, because once we get the Q3 CPI number coming out on the 25th of October, there's a possibility we could get a November hike, but the market's saying by the end of the year, there's about a 50-50 chance that we get one more hike. We're very much data dependent, so we need to see the next jobs numbers, some of the labour market statistics, and maybe we get a hike in November, but I'd say probably we're done here.
So maybe in November, because that will be after the more reliable and exhaustive quarterly inflation is out, and I'll know a bit more about how much it's working. I mean, clearly it's starting to unemployment, and it sort of focuses the mind, right? Because an extra 42,000 people are now looking for a job. That's after a 0.2% rise. So if it heads up towards 5%, we're talking about 150,000 people or more that'll be looking for a job at that point. So how many of them have a mortgage? Then you see what it does to the economy overall, right? Absolutely.
I mean, forecasting is an impossible job, as anyone who's been watching Reserve Bank statistics would tell you. But look, the RBA is suggesting that we're going to get above 4% next year. We're going to close out the year at 3.9%. That's their modelling, and then it will gradually gravitate to about 4.5% into 2025, at a time when headline inflation at that time will come back into their target. That's a big if, but that's what the scenario we're modelling.
It's a pretty rosy, soft landing.
It's a narrow path.
All the bouncing.
It's a narrow path. It's a narrow path, of course. And we're making some pretty clear assumptions to do that. So that's their base case at the moment. We'll have to see. I mean, inflation is the elephant in the room, and they're believing that we're going to get to 4.1% headline by the end of the year, and then that will gravitate a little bit lower going forward. But if we were to see a situation where headline inflation pushes higher, which I think we're going to see in the next couple of inflation prints in the US, that would really muddy the waters and cause some concerns and cause some volatility in markets.
You've got a new RBA governor making that decision, and a new look RBA, which is supposed to have even more focus on full employment, which just brings us to what is that number? Is that going to sort of, wherever we settle at, let's assume rates are done and we settle at something in that 4.5 band, will they sort of say this is full employment? Does it get more technical? What's your view on how do we define that?
It's obviously really subjective, and you've got a bunch of PhDs who are sitting there modelling various behaviours and the neutral rate of unemployment, Nauru, and all these various factors. And people are trying to understand what is the correct interest rate setting for that level of unemployment and inflation, the neutral rate, effectively. And again, so that's something that's unobservable. It's something that we have to model, and we have to believe that. But I'd imagine, we're pretty much at full employment now, and there's upside risks going forward into the year end. And look, to be honest, if you look at the pace of growth at the moment, in Q1 we're averaging about 49,000 jobs per month, per payrolls, and we've come down to about 31,000. So there is a softening of the labour market, which is probably a good thing in the Reserve Bank's eyes. It means we're not going to get such aggressive rate hikes going forward.
It's weird. We want a softening, but not too soft. You started that.
We want our cake and eat it, don't we?
Yeah, exactly. What about the Aussie dollar watch? For years it was sort of, let's not let it get too high. Now it's basically friendless. What's happening here, and what are the downsides here that they're worried about?
The Australian dollar right now, it literally can't find a friend in the market. I think you're right. But it's not really anything to do with what the Reserve Bank are doing. And I think you've seen people saying, the Reserve Bank need to raise rates to stabilise the exchange rate. Well, they're not going to do themselves any favours by doing that, because all you're going to do is smash demand and hurt the economy. It is a proxy of China. If you see Chinese equity markets falling, the Chinese yuan selling off, the Australian dollar just falls in line with that and does exactly the same. So unless they can come out and support Chinese equity markets and Chinese assets, there's really not much the Reserve Bank can do, to be fair, I think, in that situation. It's doing exactly the same as what the New Zealand dollar is, and it's really a slave to sentiment towards China, which at the moment is deteriorating. People want action from the Chinese government, and we're just not getting it. We were expecting it, because after the Politburo meeting in July, they said we were going to give you tangible fiscal support, and we haven't seen it yet. So until we do,
and more
I think the Australian dollar is
problems there in China.
There's concerns about imported inflation, but we'll see.